Okay, we're doing for chapter 20, problem 20.1b. So your assignment is 20.1a. And so let's read the problem and work through it, and hopefully this will make sense to you. All right, so first thing we're going to do is, let me zoom in a little bit more. Says Natha Inc., or whatever that is, Natha Inc., is a newly organized manufacturing business that plans to manufacture and sell 40,000 units per year of a new product. The following estimates have been made of the company's costs and expenses other than income taxes. And so if you look at the next page, 912, in my book at least, you have your fixed costs, and then you have your variable per unit costs. And so your fixed cost total is $600,000. Variable per unit cost is $80. And so it says in the instructions, A, what should the company establish as the sales price per unit if it sets a target of earning an operating income of $200,000 by producing and selling 40,000 units during the first year of operations? Hint, first compute the required contribution margin per unit. Okay? And so if you remember, let's just remember this. Revenues minus variable cost equals contribution margin. And contribution margin minus fixed cost equals operating income. Okay? So what do they give you in this problem? Well, they give you the fixed cost of $600,000. They give you the operating income of $200,000. Okay? They give you, and so this is the cost column. Make sure I get this right. We'll just put dollars here and per unit here. What they give you here is the per unit variable costs of $80 per unit. And let's see, what else? They talk about selling 40,000 units. Okay? So that's kind of the breakdown of what we know. And so the question is, what should the company establish as the sales price per unit if it sets a target of earning operating income of $200,000 and by producing and selling 40,000 units during the first year? Okay, so the hint that we're first supposed to compute the required contribution margin per unit. Okay. So how do we back into this? Well, we know this, right? We know we've got operating income of $200,000. We know we have fixed cost of $600,000. So that's $800,000. We know that we're selling $40,000 units. Okay. And so if you divide 800,000 into the 40,000, you get $20 per unit. And so this is your required contribution margin per unit. Okay? So if we stick that right here, your variable cost is 80 per unit, and we know that revenues per unit minus variable cost per unit equals contribution margin, so you can back into your revenues per unit of $100, right? So this is going to be $60